Happy evening, members. KCAA is working continuously for the empowerment of CA fraternity. It has been organizing and conducting various webinars and seminars for the benefit of members. Today, Accounting, Auditing, Corporate Allied Law Committee has organized a seminar on companies' acceptance of deposit 2014, related party transaction and MSME Form 1 as a part of knowledge sharing to CA community. For this session, I would like to welcome our today's speaker, CA Gururaj Acharya sir, to the session. Sir, welcome you, sir. I also welcome our committee mentor, Niranjan Prabhu sir, for today's session. Sir, I welcome you, sir. I also welcome. I would also like to welcome you all members on behalf of KSCA for this session. Now I request CA Niranjan sir to give opening remarks and welcome today's speaker. Sir, over to you.
Yeah. Good evening, participants. I am Niranjan Prabhu, Chartered Accountant, partner of NSPM and Associates. Today's topic, webinar on companies' acceptance of deposit rules, related party disclosures and MSME Form 1 is very apt and very much required for the day-to-day practice of our fraternity, the two are especially into companies' practice. So I'm also given the task of introducing my fellow friend from Bellary. We are both are friends from Bellary for the past 35 years. And he doesn't want a formal introduction because he is bored of hearing his own introduction. So I will go a different mode of something untraditional introduction of Gururaj. As you are aware, we both are classmates, we are college mates from degree, but we both met together in our tuitions with CA Panaraj, who is SIRC member. We both got introduced during that time. And you are aware that he has been a rank student right through his career. And because of that, in our Bellary, we used to call him as Rank Raja. He is not Gururaj Acharya for us, he is Rank Raja. And next question is, how could he achieve this ranks throughout his career? I'll just introduce him. He has studied like a sage. What he used to do, even though he is a resident of Bellary, his father had a lodging and boarding business at Bellary. He had taken one room in that same lodge, and he used to sit in the room. He used to not go to his house when 15 days, 20 days. Suppose his relatives was to come and meet him, they used to take prior appointment with him and come and meet him. That is his dedication for the studies. It used to be studies, and such a dedication is also for his practice. And to conduct webinars like this, he does a lot of homework. He gets up early in the morning and sage tapassu. He does tapassu, be it education, be it practice, or be it conducting webinars. And another aspect of Gururaj is, I will bring him his family aspect. He has two children, one son and one daughter. Son is likely to become a chartered accountant shortly. He is likely to complete his articleship from Deloitte, Huskins and Sells, Deloitte. And his daughter is doing his engineering. And shortly his son may, I don't know the children's perspective now, may be the successor of his practice, or he may join him as a left hand to Gururaj Acharya. With this brief background, I introduce you to Gururaj Acharya. And coming to the sessions, he brings life to the sessions. I have heard a lot of sessions which would be a routine, mundane, presenting the papers, and it will become after 15, 20 minutes or half an hour, 45 minutes, it becomes bored. But Gururaj sessions will always be a lively session. You will never get bored during this session at all. So with this introduction, I request Gururaj Acharya to take over the session.
Thank you, my dear friend Niranjan. I call you as my dearest friend today for two reasons. One is, of course, you've given me a very good introduction. Tapasvi anta karadidiri. I mean, you have seen me in action, so thank you so much for bringing out the good remembrance of those old days. 35, you've taken me back 30 years.
Unforgettable days.
Yeah. And about Niranjan, I should say he's the self-made man. I mean, I have seen Niranjan growing up. I mean, if I may have to say this, I have to say this to everybody, so much so that he used to sell milk, Nandini milk or KMF milk early in the morning in the street. And now he has become a very leading chartered accountant, and I'm very proud of his achievement too. And one great thing about Niranjan is he's known for his PR skills. His public relations skills are unmatchable. So, a lot of things to learn from Niranjan. Thank you so much for that nice introduction and taking me back in life. And I should also, I mean, this is the third time I am coming to KSEA during this year. I mean, post-pandemic. I mean, if I may have to say, after Corona, this is the third time I am coming. But for the first time, I am coming under the leadership of the new team led by Kumar Jigajani. So I congratulate the new team and I wish them all the best in their term for 2021. And it is very nice of the mentor of this particular committee, the KSEA's Committee on Accounting, Auditing and Corporate and Allied Laws Committee, they call in KSEA. They have taken up this, and I'm told under this banner, this is the first program. And Niranjan and Gaurish, the chairman of this particular committee, he has taken all pains in making topics are relevant, discussing with the mentor and then discussing with me. Then I said, this is a better topic for the day, covering about MSMEs, DPT or deposits, and related party transactions, because all these three things are protecting a particular sector. Let us try to understand the objective behind these three topics, which we are going to deal in detail. MSME, Form 1, what we need to file with the ROC, I will get into the details a bit later. But this particular MSME, the payments which are due to MSMEs have to be paid within the agreed period, not later than 45 days. Why is that particular provision there in the MSMEDA Act? It is just to protect the small vendor, and to make it sort of all inclusive. Otherwise, only the big will become bigger and the small will become smaller. So just to ensure that the economy grows in a proper way, I think the particular the authors of MSMEDA Act have done this particular thing. And how is it connected to Companies Act? I will talk a bit later on. The second thing is on deposits. Which is going to be a great provision in the Companies Act to protect the gullible depositors. Because they are the provisions introduced in that particular chapter 5, dealing with only 4 sections, you will see, is talking about protecting the gullible investor, because he thinks that the moment he thinks that it is a company, he falls an easy prey to that particular invitation or any allurements that the company will give. So that he does not give, and more than he giving it, the company itself is barred. From taking money from anybody else who comes forward to give this particular money, unless there are certain exceptions. If they have to take deposits, they have to comply with a lot of provisions. We will see that in detail. I'm just giving a precursor as to why this particular chapter, one whole chapter in the Companies Act is devoted towards protecting the depositors. The third topic which I will be talking about is on related party transactions. Again, for whom is this particular chapter, or it's only one section actually. It is only one section within chapter 12. Chapter 12 dealing with Board of Directors meeting. Chapter 12 in the Companies Act deals with the Board of Directors meeting. Within that particular chapter, 188 is there to protect the investors, the general investors, from those transactions which happen within the related party, or between the company and the parties who are related with that particular companies, so that the general investors are not the general investors, the general shareholders, including the bankers, are not, let us say, taken for a ride with the transactions that are happening between the company and its people who helm the affairs, or its management, if I may have to say. So these are the three very important chapters. One is to protect the small vendor. The second one is to protect the gullible, I should say, depositor. And the third chapter on related party transactions is there to protect the general investors, or if I may have to say, the minority investors. They need not necessarily be minority in that sense, but the management, if I may have to say, management and the related party should not be benefiting only the management at the cost of the general shareholders. I think that is the objective behind having these three provisions within the Companies Act. Now I proceed with my presentation proper, but before that, I also have to acknowledge the presence of the moderator, Mr. Santosh. What I'm going to do is, I'm going to deal it in three particular silos, three particular sessions within these 2 hours. I will talk about MSME in the beginning, then I will go to deposits, and lastly I will cover related party transactions. When I talk at the end of every session, I will ask Mr. Santosh, the moderator, to ask a couple of questions just to break the monotony. So therefore, I request all of you who are listening to this particular session to be punching in the questions in the Q&A box. You please punch in your questions in the Q&A box, and whatever questions, a couple of questions, I would like to take all the questions at the end, but a couple of questions which Santosh feels could be of general interest, he will ask at the end of every session just to break the monotony. So that's the way we are going ahead on this particular session on. So wonderfully done a brochure, I should say. I really appreciate the brochure itself, is so attractive. It covers the entire gamut of KSEA, what is there, what should I say, the motto for the year, think, I'm sorry, evolve, excel and empower is what they are saying. And I'm happy that this is a professional development series of HC Kincha, the leader in our profession, and DC Charger. So while I recognize that, so we are talking about the session in particular. I also see the wonderful names of the new President, Kumar Jigajani, and Pramod, the Secretary. Of course, Gaurish is also there here as the chairman of this particular session. And I'm told that the convener, Deepa, would come at the end to talk about this particular program. So let's now get into the session proper. So I will be talking on three topics: acceptance of deposits, related party transactions, and its implication. I would not just stop about talking about that, because I am fully aware that the people who are listening to this particular session are all chartered accountants, may not necessarily be specializing in the Companies Act, may not be specializing in company law practice, but probably they're all chartered accountants, auditors. They would like to know how are these topics relevant to the audit of the corporates which they are doing. While this session would help in also complying with the provisions for doing a company secretarial practice if somebody is interested, but I will also focus on what are the from the audit perspective, what are the precautions that one has to take when he is reporting on these matters. In fact, at least these two chapters on acceptance of deposits and related party transactions, there are specific questions asked in CARO. I will go into that very detailedly. So we need to understand what is the compliances under these sections, what is the reporting required for CARO, and what is the role of auditor in the statutory compliances. So while acceptance of deposits and related party transactions have a CARO relationship, I just put MSME Form 1 in a small font there for a reason, that MSME Form 1, there is no big responsibility on this form as far as the auditor is concerned. However, with respect to the general compliance, yes, there are reporting requirements which I will cover in my session. So if you look into, straight away, let me get into the easier of the three topics, which is on MSME. Companies are required to file MSME Form 1. Which companies? All companies. When was this told? This particular provision was brought in to the Companies Act as recently as 22nd January 2019. So almost 1.5 years now, this has been there. And how was it introduced? It's very interesting. There is section 405 in the Companies Act. Now, look at this, MSME protection is not given by the Companies Act. MSME protection is given by MSME DA Act. The Micro, Small and Medium Enterprises Development Act is the one which protects the MSMEs. And what is the relationship between that act and Companies Act? Let us try to understand. Section 405 of the Companies Act gives the power to the central government to direct all companies or any particular company to furnish any information to the register of companies or to furnish any statistics that they want to collect. Now, under that particular section, a notification was given on 22nd of January 2019 to say that every company, all company, even that company could be an MSME. Let us be very clear. It is not only large companies, all companies. It could be a government company. It could be an MSME itself or a large company, a public sector or a private sector, all a listed or an unlisted company, private limited company, public limited company, all companies who gets goods or services from micro and small enterprises, Look at this. I have very consciously used the fonts in a different color there, micro and small enterprises. Although the Act, MSMED Act covers 3 types of enterprises, micro, small, or if I may have to use a better finger, a micro is a little finger, small and medium. The protection under the information that is required to be furnished to MSMEDA, to the ROC is only about micro and small, nothing about medium. So only 2 types out of the 3, the dues to such enterprises need to be furnished in MSME Form 1. So all companies who get goods and services from micro and small enterprises and whose payments are more than 45 days due, in fact, that's the word, whose payments are due for more than 45 days from the date of acceptance or deemed acceptance of goods or services as per provision 9 of the MSMEDA Act shall submit in MSME Form 1 stating what amount of payment due, what is the amount of payment due beyond 45 days and the reasons for delay. So this is the information that has to go by every company. The normal question that keeps asking is, should every company file this Form 1 or should it be filed by only those companies which are procuring from micro and small enterprises? The answer is not every company, but those companies which have procuring from MSME. The next question that could come out is, should every company procuring from MSE, micro and small enterprises, should file Form number 1, or should it be only those enterprises where the dues to such suppliers are more than 45 days? The answer is not there, but we have generally understood after discussing with various authorities that only if there are dues beyond 45 days, then and only then this needs to be filed. And the best part is there is no filing fee for this, because after all, it is information being furnished to the benefit of, it may be to the benefit of the other person, or it is only a statistics or an information gathering mechanism. So therefore, there is no filing fee specified for filing this particular fee. But the worst part or the noting point is this form is to be filed not once in a year, but twice at every half-yearly interval. So every company, so let us now summarize to say every company which procures goods or services from a micro and small enterprise, not medium, let me be very clear, and whose dues are more than 45 days have to file. Only if their dues are there for more than 45 days, then they have to file at half-yearly intervals. That is the first half year from April to September, they have to file within 1 month from the end of the half year, that is by 31st October. And October to March, they have to file it by 30th of April. So within 1 month from the end of the relevant half year, they have to file this particular form. They have to file, and there is no form for this particular filing. Now let's move further to understand this better. What is micro and small enterprise? What is micro and small enterprise? So this is the original definition has been replaced with a new definition from 1st July 2020. So about 3 months back, the definition of micro and small and medium enterprise, all of them have got changed. But the focus for our discussion today, when we talk about MSME, is only micro and small enterprise. Whereas the old definition up to 30th June 2020, which I have given in the first column, you may have used the word second column there, is in relation to investment in plant and machinery alone. Only under investment in plant and machinery, whereas the new definition is now talking about two cutoffs. One is in relation to investment in plant and machinery, and the second one is in relation to turnover. Now let us understand, any one of them breaching, they move out from that segment to the next segment, or the next segment, or out of this segment altogether. So let us for a moment understand what these cutoffs are. I will not talk about the old. You can see that. And while there was in the old scheme up to 30th June, there was a distinction between goods manufacturers and service providers. There was a distinction between manufacturers and service providers. And for the manufacturers, the higher level of investment in plant and machinery was prescribed. For service providers, the lower level was prescribed. That is how under the old scheme, for example, if you were to be a micro and a manufacturing entity, the investment in plant and machinery up to 25 lakhs was okay. But for a service provider, what was given in bracket in small, 10 lakhs was the cutoff. If it were to be more than 10 lakhs, up to 2 crores, for a service provider, he would have become small. From 2 crores to 5 crores, for a service provider, he would have become medium. Whereas for a manufacturer, up to 25 lakhs was micro, 25 lakhs to 5 crores was small, and 5 crores to 10 crores investment in plant and machinery was medium. So this was the old scheme. Under the new scheme, with effect from 1st of July 2020, there is no distinction between manufacture and service. So for both of them, the cutoffs are the same, unlike in the past. And unlike in the past, the cutoff is not only based on investment in plant and machinery, but also considering the turnover. That means my investment in plant and machinery, if you look into micro, they say 1 crore, but the turnover cutoff is 5 crores. The turnover cutoff is 5 crores. Let us say my investment in plant and machinery is 70 lakhs, but my turnover is 25 crores. For 70 lakhs, if my turnover is 25 crores, then I will be categorized as small and not as micro. I will be categorized as small and not as micro. A point to be noted there, if any one of them breaching, I go to the next level and I don't stay at the same level. So micro, investment in plant and machinery 1 crore, turnover is 5 crore. For small, it is 10 crores of up to 10 crores of investment in plant and machinery and up to 50 crores of turnover. And for medium, it is up to 50 crores in plant and machinery and up to 250 crores of turnover. Now, what are the points to be noted here? The points to be noted are both to be within the limits, which we have already seen. Traders are even now not covered. A pure trader will not be covered under this particular MSME at all. There is no protection in that sense from the MSME Act for the trader. This was so even under the old regime, even under the new regime, this will continue. Having said that, what is how do you calculate the investment in plant and machinery? How do you calculate the investment in plant and machinery? Under the old act, we used to go by the investment in the books, the purchase price, the gross block, the purchase price was the determination for investment in plant and machinery. Now they have changed it to whatever is declared in the income tax return, that to the return on value. The return on value of the plant and machinery block as given out in the income tax return becomes the basis for determining the investment in plant and machinery. So from the purchase cost, it has now moved down to investment return on value in the income tax form. Whatever is the return on value in the income tax return, that becomes the basis. How do you determine the turnover? Very interestingly, the turnover is again as disclosed to the income tax department, as disclosed in your income tax return. However, very interesting thing is to boost the turnover, to boost the export turnover, they have in this limit of 5 crore, 50 crores and 250 crores, exports are not counted. So this turnover excludes the exports. Point to be noted, a couple of things to be noted is plant and machinery, when we say it is as per the income tax return. Now you must understand, in income tax, there is an appendix 1 as prescribed in rule 5 of the income tax rules, which gives us the depreciation schedule for income tax purpose. And in that particular appendix 1, we have actually two types of assets classified broadly as tangible and intangible. So plant and machinery comes under tangible assets. And within tangible assets, we have got only 4 further subclassifications. One is building, second one is furniture and fixtures, third one is plant and machinery, and fourth one is ships. So now building, in fact, please note that land is not considered to be an asset in income tax within the depreciation schedule, because land is not subject to depreciation. So we have building, furniture and fixture, plant and machinery, and ships. So we are now talking of the third element of plant and machinery. So now plant and machinery does not mean only machineries. It could include all those items which comes under the third heading of plant and machinery under the income tax schedule. It could, please note, include your cars, the motor cars or the motor vehicles, could use lorries, etc. All of them are plant and machinery block for the purpose of income tax. However, MSMEDA Act excludes a few plant and machineries, such as pollution control equipments, such as R&D equipments, such as safety equipments and other prescribed equipments. So these are the points which one has to note when you deal with the plant and machinery return on value of income tax. So let me just elaborate Form 1. Details to be furnished in MSME Form 1. Total amount of payment due. What is to be furnished in Form 1. And let me, before I get into this, let us understand what is this MSMEDA Act all about. MSMEDA Act says that anybody, not necessarily a company. MSMEDA Act goes to the extent of saying any person who is any person who is purchasing goods or services from a micro and small enterprise. We have seen what a micro and small enterprise is. Medium, again, there is no protection, as I told you already. Any person, it could be a partnership firm or a proprietorship concern or a company. Whereas MSME Form 1 has to be filed by only a company. Proprietorship concern, partnership firms are also covered under the MSMEDA Act. So what does this MSMEDA Act say? It says that every business entity which procures goods or services from a micro or small enterprise has to pay for that goods or services within the agreed period. And that agreed period cannot be more than 45 days. And if you are paying beyond agreed period or 45 days, as the case may be, then you shall pay to the vendor. Along with his dues and interest at the rate of 3 times the bank rate. The bank rate today is about 4.5%. So you'll have to pay in 4.5% into 3. That is the interest which you shall compulsorily pay, and that interest will not be allowed for income tax purpose. Very interestingly, who tells this that particular interest what you paid? Let us say the interest on a particular MSME for a particular year comes to about 25 lakhs. This 25 lakhs of interest which is paid, which is provided for, paid or otherwise, will not be allowed for income tax purpose, is told very interestingly under Section 23 of the MSMEDA Act. Section 23 of the MSMEDA Act says that this interest which is paid will not be allowed for income tax purpose. In fact, we are telling about this in the tax audit report. In the tax audit report, there is a particular question asked. Are there any interests which are to be disallowed under Section 23 of the MSMEDA Act? So that is the point which one has to note, that that interest will not be allowed for MSMEDA under the Income Tax Act. So let's see what is the items that is to be filled in this particular form, which has to be filed every half year. Total amount of payment dues, type of return, one-time return or half-yearly return. In fact, we were supposed to file a one-time return. The due date was on, due as on 22nd January since inception to date. So that date is already gone. We don't have to do that. At half-yearly intervals, we are supposed to fill in for all those amounts for which the goods have been procured between April to September and due beyond 45 days. It may not be due as on 30th September. Please note, it may not be due as on 30th September. You might have bought something in April. May 15th, April 1st, if you have bought it, by May 15th, you should have paid him. If you have paid it in June, July, it will not be outstanding as on 30th September. It will not be outstanding as on 30th September, but you shall file this particular return showing that particular payment of paid beyond 45 days in this particular figure. So that is how you'll have to note this. Similarly, October to March, the due date is 30th September. Particulars of the name of the supplier and amount of payments due, financial year, name of the supplier, PAN of the supplier, amount due, specify the date from which the amount is due, and the reasons for delay. If there is, you'll have to also explain the reasons for delay. So consequences if the company fails to file the e-form MSME 1. We also saw this, that this is coming by virtue of section 405. Section 405 of the Companies Act tells that once it is the central government empowers the ROC or every company or mandates every company to file certain information. This is the information which is filed under section 405. If you do not comply with any of that mandate which is required to be filed, then the penal consequences on the company is 25,000 rupees, and for the officer in default, the fine could be 25,000 to 3 lakhs or imprisonment of up to 6 months. So we have already seen this. This is the clause number 22 in the bottom, what I was talking about, amount of interest inadmissible under section 23 of the MSMEDA Act. And apart from this, the auditor also needs to know one very important thing, that every business where we are doing a tax audit or a regular audit has to contain in the notes on accounts. We normally see this in companies. Please be clear that this particular additional information is to be given not only for companies but also for proprietorship concern and partnership firms which are subject to audit. So you'll have to give this additional information. I'm not getting into the details of that. So whatever we are giving is only in relation to the dues to micro and small enterprises. Similarly, in the case of a company, Schedule 3, both under the accounting standards and under the Ind AS division, whether you may follow Division 1 or Division 2, you will have to give a line item under the heading trade payables as how much of the trade payables is outstanding and due to the micro and small enterprises. Again, please note, you'll have to give this breakup only to micro and small enterprises, although the Act covers also medium enterprises, and total outstanding dues of creditors other than micro and small enterprises. Now, that gets me to the end of the first chapter on MSME. Santosh, are there any questions?
Yeah.
Are there any questions? I can take a couple of questions on MSME before I go to deposits.
Yeah, we have a few questions, sir. The first one, should the 45 days be reckoned from the due date of payment or the date of acceptance of goods and services?
Yeah, that's a good question. What is told is, if you see, the due date of 45 days starts from acceptance or deemed acceptance. Acceptance or deemed acceptance. Now, what is the meaning? Acceptance means the day I sign the GRN. If I have to say the GRN, goods means goods received note. Services means when we always say let there be a services received note. However, if you have not given a goods received note, but there is a delivery challan from the other person, supplier, then we say that the person accepting it, if he does not give an objection within 15 days from the date it is delivered to him, within 15 days, if I don't inform about the defect in the goods, or if I have not told him that I have accepted, then it is deemed to be accepted. So accepted, we know what it is. Deemed to be accepted means from the date of delivery, within 15 days, if no objection is given by the buyer, then it is deemed to be accepted from the original date of delivery. So 45 days clicks in from there.
Yeah. We also have a question which asks, what would be the penalties for those people who get the MSME recognition under wrong criteria, under wrong codes?
Okay, I think that's a very good question. I think one has to look into the MSME for that. One has to look into the MSMED Act for that. And very interestingly, today there is a department called, if I may use the word as an acronym, it is called MOMC, Ministry of micro, small and medium enterprises, MOMC. That is the ministry which is actually catering to the micro and the providing the benefits to the or should I say that is the which is administering the Micro and Small Development Act. That ministry has a tie-up with the CBDT now. I mean, last month or so, a couple of months ago, they had they inked an understanding with the CBDT, wherein the information what we file in the income tax return will be auto-populated in the Udyog Aadhaar. I mean, that is the form which we need to file when we are filing for the MSME. So it will not allow you to, it will not allow whatever is the information in the turnover or in the case of return on value of plant and machinery will get auto-populated in the Udyog Aadhaar. And therefore, and very interestingly, this has to be updated every year. I mean, our form also has to be updated every year, because you may be micro 1 year, subsequently you may upgrade yourself, or you may not be a MSME altogether. So therefore, there is a penalty prescribed under the MSME Act, and I don't know how much. Definitely there will be a penalty, but it looks like the system itself is so designed that you will not be able to manipulate it any further, because it takes from the income tax return itself. Yes, Santosh.
Can we take one more question, sir?
Yes, one more question, and then we proceed.
Yeah. So what are the responsibilities?
But let us take all the questions at the end. I mean, you please preserve all the questions for the end, okay?
Yeah, sure. So the question is, what are the responsibilities as a statutory auditor to ensure that the MSMEs have been comprehensively identified by the company or the client, and how do we audit their creditor identification exercise?
Yes, I think that's a very good question again. As an auditor, what is my responsibility? My responsibility is to ensure that the information about all the vendors are properly collated by the company. This, the vendor could have given it on a suo motu basis. I mean, in his invoice, or he could have, because he is a MSME, he would like to probably get his priority payments. So therefore, he would have given it. Or in case he does not give, it is the responsibility of the buying company to get this additional information from each vendor at the time of entering into the contract itself, that whether you are a MSME. So the company should take it, or subsequently the company should anyway try to get it. So we'll have to, as auditors, see what is the process followed by the company to collate this particular information, and they should do it in every case. And we as auditors have to do a sample check whether the obtaining of the information by the company, the system is there, and also whether the classification of the vendors is properly done in the accounts, and thereafter whether this information is properly furnished. So as far as I am concerned, I would go to, because for the audit point, for my audit perspective, I talked about two particular disclosures. One is the disclosure of additional information which is to be given. So this disclosure, the company is responsible primarily, and I as the auditor am responsible to ensure that this information is proper. Similarly, as far as the company is concerned, I have an additional responsibility of ensuring that this particular classification or presentation, if I may have to say, has properly been given by the company. And I as an auditor have to ensure whether the system of collecting the information, classifying the information is proper. And I have to do a sample check if the numbers are huge. Yeah. Thank you, Santosh. I will proceed further. Now, yes. Now I'm getting into the area of deposits. I'm getting into the area of deposits. Now, before I get into the area of deposits, for this session, I prepared two very important slides, which I felt was very important for us to. I mean, it's a very good, because Niranjan, when he sent me, Niranjan and Gaurish, when they asked me to talk on chapter 9, chapter 10, and certain sections, I said, while chapter 9 and chapter 10 very important sections for the company auditor, I will deal with these three chapters on deposits, related parties very importantly, because they have an audit implication which probably the auditors may not be aware. No? And then when I talked about that, I thought about one more thing, saying that whenever I talk about tax audit, I try to make an analysis of Form 3CD to find out how many sections are actually asked in Form 3CD. In fact, there are about 86 plus 1 sections asked in Form 3CD. Similarly, it intrigued me to find out how many sections are asked in the audit report which I am giving for a company. For a company, when I am giving an audit report, how many sections am I supposed to refer to in my audit report and CARO? Now, this slide is very, very fresh for that matter. 9 sections have been asked in the main audit report. So what do they deal with? Now, the different colors there indicate the different chapters. Clause 1 and 2, dealing with 133 and 134, deals with chapter 9, which deals with accounts. Now, you will see that I'm fascinated with this number 9, because 9 is the best number, the most sacred number for all of us, because that is the highest number. I mean, after that, it is a mix of that particular number. So 0 to 9, if one may say, the 9 is the highest number that we can think of. Now, having said that, they have given the chapter 9, the most precious number, to our field of accounting. And next chapter is on, again, a very interesting chapter, chapter 10. If 9 is important, 10 is more important. I mean, more interesting also. That is why if you see a lot of captains for cricket team, they have on their jersey the number 10. So the captains of the team will have 10 under their jersey. Just like that, Companies Act has considered the auditors as the captains of Companies Act. Although the terminology of captaincy should have been used for directors, directors are covered in chapter 11. When I was again very shocked to see director should come first, and then if you read the Companies Act, it starts with the incorporation and goes up to winding. So if it in the same sequence, the management should come before the auditors. But then the Companies Act authors felt that auditors are more important than the directors themselves. So they have placed them in chapter 10, and in chapter 11, the auditors are placed. So chapter 10, I always very jocularly use chapter Tendulkar. Tendulkar had in his jersey 10. So we should always be proud that we are covered in chapter 10 of the Companies Act. But at the same time, we have been given a responsibility of being the guardian of the Companies Act. That is what I was trying to say. MSME tries to protect the vendor. Deposit tries to protect the gullible depositors. Related party transactions tries to protect the shareholders against any transactions which are done with the related party transactions benefiting only the related parties. So I, as the guardian of the investors or the depositors, have to throw out any violations of those particular sections through my audit report. Now, if you see Companies Act main audit report, I am referring to 9 sections. Section 133, dealing with accounting standards. I am saying that financial statements are in accordance with the accounting principles generally accepted in India, including accounting standards specified under section 133. So that is a statement. So 133 is where Companies Act recognizes accounting standards, read with Rule 7 of the Companies Accounting Standard Rules, which gives 2 types. One is the normal Companies Accounting Standard Rules and Ind AS. Then I am also referring to section 134 bracket 5, Director's Responsibility Statement in the board report. Very interestingly, those of you who want to do some research on the Companies Act, you will find out that Director's Responsibility Statement is not there under the chapter of directors or the board report. It is there under the chapter of accountancy. What do I have to say in my audit report? Company's board of directors are responsible for matters stated in 134.5 with respect to preparation of these financial statements that give a true and fair view. These are chapter 9 sections referred. Then I go to chapter 10 sections 143.3. 143.3, the moment I say 143.3, I can also talk about the assessment order in the Income Tax Act. But 143.3 in Companies Act refers to the assessment of the company by the statutory auditor of that particular company. He assesses the overall financial statements, whether it reflects the true and fair position of the operations of the particular company and whether it is properly captured. If not, are there any misstatements which require a qualification? So that is what I am going to give in my 143.3 auditor's report. So I am saying, as required by 143.3, I am supposed to report on points A to 1. It could be agreement with the books, seeking of information, like that. I'm giving A to I points along with the points under rule 11 of the company's audit and auditors rules. I'm supposed to give 3 other additional information, which is coming not out of 143.3, but out of the rule 11, which is actually prescribed in 143.3. Then under the 4th point, I'm supposed to give the section that I'm referring in particular is 143.3I, internal financial controls with reference to financial statement. So under section 143.3I, I'm going to say we are responsible for expressing our opinion whether the company has adequate internal financial control with respect to financial statements in place and operating effectiveness of such controls. Whereas there are certain companies which are exempt from the application of this, and where I don't have to give. But for all other companies which are not covered under the exemption, I have to give this particular thing. But for every company, whether there is an exception or not, I may not report it, but I have to look into the control aspects before I'm giving an audit, even for those exempted companies. Now, 143 subsection 8, this is applicable only if there are branch accounts, branch offices, and those branch offices are audited by some other chartered accountant, wherein I will say that the reports on the accounts of the branch office of company audited under section 143.8 by the branch auditors have been sent to us and have been properly dealt with by us in preparing this report. So I'm going to say that they have been dealt with by those branch auditors, and it has been sent to us and have been properly dealt with us while I am preparing the main audit report. Their qualifications I have assumed and things like that is what I am supposed to give. And this is not there in every case, only if the company has a branch auditor and that branch auditor is different from the main auditor. Only then this point number 143.8 will come into picture. Then 143 subsection 10 gives a statutory recognition to standards on audit. For the first time in 1956 Act, there was no recognition of the standards on auditing, whereas standards on auditing was mandatory on the chartered accountant by virtue of our institute. Now, if some chartered accountant is not following the standards on auditing, while our institute can take up a disciplinary proceeding against me, Companies Act can also levy a penalty under the Companies Act if section 143.10, which recognizes standards on auditing, is not complied with. So there, wherein I'm going to say I have conducted my audit in accordance with standards on auditing specified under section 143 subsection 10. Then I'm also referring to 143 subsection 11 dealing with CARO. As per section 143.11, I am supposed to give a statement on the matter specified in para 3 and 4 of CARO to the extent applicable. And then this ends, these are 1, 2, 3, 4, 5. There are 5 sections talked about from chapter 10. Then I enter chapter 11, where I am talking about whether there are any directors who have got disqualified. It becomes auditor's responsibility again to say, are there any disqualified directors? So if so, I have to give a mention of that. So I am taking a representation and also doing a independent verification as to whether directors have been disqualified. And that is what I have to say there. And finally, there is one more section, section 197. Please note, for all the public limited companies, this is applicable. It is not applicable to private limited companies. 197 subsection 16 tells that the aspect of managerial remuneration not in excess of section 197. 197 tells me the overall cap up to which the directors can be paid as remuneration in a public limited company, not applicable to private limited company. So in every public limited company, in the main audit report itself, I have to say that the director's remuneration has been paid within the prescribed limits as told in 197. Or if there is a breach, I'll have to say how much is the amount in excess and whether the company has taken adequate steps to recover that excess money. So this particular note, this particular what should I say, mention should be there in the main audit report itself if it is a public limited company. If it is a private limited company, there is no need to talk about this. So while this, we are talking about 9 sections, I move forward. This is the basis for me to talk about the DPT and related party transactions. One may be thinking, why am I talking about audit report in a DPT and RPT situation? Just to talk about, if from the main section, main audit report, which deals with 9 sections, I am moving to CARO. What does CARO deal with? CARO, we had 2003 version, 2009 version, 2016 version, and 2020 version. Now what we are, fortunately, 2020 version, which was given out, having 20 plus 1 points, has got deferred due to Corona. So therefore, this year we are supposed to give Caro 2016 only. And very interestingly, 2016 has got 16 paragraphs, or 16 clauses under which the chartered accountant is supposed to answer it's a question and answer type of a situation. I'll have to answer very specific questions. So what are the various questions that I am asked there? What I did was, out of the 16 questions, I segregated into, for the sake of this, I brought out the entire Caro in one slide. I mean, I call it as the Vishwarupa of the Caro. The entire Vishwarupa of Caro is brought out in one slide to talk about, very interestingly, when I did my research, I got, I mean, maybe all of you can know that, but then when it's put it in a proper format, it becomes very easy for us to understand. Caro is talking about two very important classifications. One is, it is talking about compliances with Companies Act under very specific headings of sections, and Caro is also talking about other audit matters. It could talk about other reporting aspects. Now, what are these other reporting aspects? It is talking about property, plant and equipment. It is talking about inventory. For that, I don't need to know Companies Act. I mean, my auditing standards on auditing is what I need to know. And maybe my general skills on accounting, general skills guidance note on auditing. These are the things that I need to know when I am doing the reporting of Caro on the following 12 points, the 12 matters which have been covered there. And how I have covered this particular thing is, this one slide covers both 2016 aspects and 2020 aspects. How is that you know what is this 2020 aspects? Anything which is underlined in this particular slide is asked in 2020. Now, for example, property, plant and equipment, which is given below, PPE, proper records. Yes, we are supposed to see whether proper records are maintained by the company with respect to property, plant and equipment. And there I have said for intangible assets also underline. So in Caro 2020, which is applicable from next year, I also have to take into account whether proper records are there for intangible assets also. Then physically verified by the management, and accounting for discrepancies. Have they properly accounted for the discrepancies? Whether there are title deeds for immovable property in the company name. This is there in 2016 version and 2020 version. In 2020 version, they've also asked details of revaluation or proceedings under the Benami Act. So this is how I'm talking about this. For this, I need to know only my standards on auditing, my accounting standards, my maybe Schedule 3 to some extent. Schedule 3 also I need to know whether it is properly valued and things like that. So now, or classified, classification, disclosures, etc. Now, when you talk about inventory, physically verified by the management and accounted for discrepancies, I have given something in red. Two things I have given it in red. Agreement with the books of quarterly returns filed with the banks. Very important. In the 2020 version, which is applicable, which was supposed to be applicable for this year, fortunately got deferred. They are talking about agreement with the books of quarterly returns filed with the banks. Now, if any company has borrowed more than 5 crores from any bank, they are supposed to file every month. Every borrower has to file stock statement, but on a quarterly basis, they are supposed to file quarterly information reports. Some banks call it as quarterly information reports, QIS, FFRs. These are the various names called by different banks. So that quarterly information contains data, stocks, creditors, sales, purchases, profits, net working capital, all those things. Now, whether that information given to the bank is matching with the books that is being submitted, what is submitted and it should be as per the books is what is required. So why am I talking about 2020 now? Just to say that what you have to report next year in the audit, in the Caro report, is actually the information which is happening. Now, today we are on 22nd September. On 30th September or 30th June, you might have already given, 30th June 2020, you might have already given a QIS. The company might have given this particular information to the bank. When we do the next year audit, we have to be clear that this information in the return and the books should actually match. If not, I will be giving a qualification to that extent, which may be detrimental to the company, because the bank will then consider it as a company of not a good integrity. So we better warn our clients that we are required to give such an information henceforth in our audit report. So please ensure that whatever you are submitting to the bank is given consciously and matches with the books of accounts. Now the third point is unrecorded income disclosed in IT assessments. Then like that, statutory dues, repayment defaults, application of funds raised by way of IPO and FPO, Nidhi company certain information, registration under 45(1)(a) of the Reserve Bank of India if applicable. Let's understand where is it applicable? Where is this registration of under section 45(1)(a)? Now one may say that this is applicable to NBFCs, and section 45(1)(a) of the Reserve Bank of India Act says that every company, if its total investments in the balance sheet, total investments and loans, that is financial assets, not represented by any particular machinery, land, building, tangible or intangible asset, a financial asset, if financial asset is more than the total asset by 50%, and I underline the word and more than 50% of my total income is by way of interest or dividends from such financial assets, then I am deemed to be a non-banking finance company and I am supposed to go to the Reserve Bank of India and register it. It could happen in a pure holding company. Without my knowledge, I would have become a 50-50 test. I would have breached the 50-50 test, which is technically called as 50-50 test. So in that context, the registration under section 45(1)(a) of the Reserve Bank of India Act is required. The next point is the ability of the company to meet the liability in the next 1 year. Now, while going concern is a matter of great concern for the auditor and for the company it is a concern, and the auditor has to report on whether the company is on a going concern basis. If not, I have to take additional measures. I'm not getting into that today. But here I have been given an added responsibility, apart from talking about the going concern from the balance sheet date, as on the balance sheet date, I have to see if in the next 1 year, does the company have the ability to meet its liability in the next 1 year? Now, this is a very, very tough question, which we wanted to avoid it. When we are still seeking, our institute is making representation not to seek this particular question because it's very difficult for any auditor to comment on this. Anyway, this is required only from next year. For this year, let us be warned about such a thing coming in future. Statutory auditor's resignation is another point which needs to be covered from the next thing. Internal audit system and cash flows was there in 2003 version, reintroduced in 2020 version. Now, why did I talk about this? Saying that Caro talks about so many aspects, but if you look into the top, it talks about 9 sections, nine particular clauses dealing with 15 sections in the Companies Act. It deals with 15 sections in the Companies Act. Those sections, at least, we should, even if I don't swim the entire ocean of Companies Act, I may have to probably swim in these sections and have a mastery over these sections if I have to do a company audit. So what are these sections? Section 185 and 186, dealing with loans, investments, guarantees, and securities. What should I answer? And in 2020 version, it says details of such amounts in general and particularly to related parties have to be commented upon. Then I am supposed to talk about section 73 to 76 dealing with deposits, and section 148 maintenance of cost records if applicable. They have specified certain category of companies should maintain cost records, and certain of them should get their cost audit also done. So you'll have to see as auditors whether the companies, the sectors in which, the industry in which the company operates is required to maintain cost records. Section 42 and 62 talks about how the shares are allotted either as private placement or as preferential allotment. Section 197, which we talked about, managerial remuneration. Very interestingly, this is deleted in 2020 version as it is anyway covered in the main audit report under section 197(12), which we just now saw. So section 177 and 188 related party transactions. Section 192, non-cash transactions with directors. If there are any barters, there are no exchange of assets and giving up of shares or something like that. Non-cash transactions with directors or persons connected with them. Section 143(12) has been introduced as a section in 2020 version. Otherwise, I'm supposed to anyway report on the frauds. And in the 2020, I am also supposed to talk about CSR, whether the funds are required to be transferred once that section becomes applicable. If for the moment section 135 subsection 5 and 135 subsection 6 are inoperative, they will be made operative from a date yet to be notified once the Companies Amendment Act 2020 comes into picture, which is passed in the Lok Sabha, yet to be passed in Rajya Sabha. If that happens, then 135(5) says that any unspent money on the CSR has to be transferred to the fund account of the government. So that is the requirement. For the moment, it is not there. So anyway, as auditors, we are supposed to say whether it is transferred to the fund account or if it is on an ongoing project for which the companies will be spending in the next up to 3 years time they've got, has it been transferred to a separate bank account called the ongoing projects special account under section 135(6). So if that section gets activated, the auditor's responsibility gets increased. So that anyway is covered in 2020 CARO, not in 2016 CARO. So there are about 7 plus 2. Why did I talk about plus 2? Plus 2 is one on the managerial remuneration anyway, which will go, and CSR, which is going to yet to come. So for the moment, I am supposed to talk about 7 clauses. And very important, today I will be talking out of these 15 sections. I will be talking about 4 sections under deposits and 2 sections under related party transactions. So 6 out of 15 sections of what is asked for in CARO is what I'm going to cover in the next few minutes of my session. Santosh, are there any questions till now?
So we have a question on the calculation for section 198 managerial remuneration. Would you like to take that, sir?
Just read out the question.
The question is, what does capital nature of...
Sorry?
The question is, what does capital nature of revenue or income means in section 198 for computation of net profit for managerial remuneration?
See, what is happening is, of course, I will not get into the details of it. The question is whether profit on sale of fixed assets is also to be considered, yes or no, for the purpose of managerial remuneration. There is a particular part of that profit on sale of fixed asset has to be considered for managerial remuneration. There is a way in which it has to be considered, not the normal profits which we take it to the credit of profit and loss account. They have prescribed a methodology. Using that methodology, we have to get into that. So I will not be able to explain how that methodology has to be done in a session like this. And it is also beyond the syllabus for the day. Okay. Any other questions in general about what I spoke?
No, sir. I think we can proceed.
Yeah. Yeah. I will now concentrate for the next 25 minutes on deposits and thereafter on the related party transactions, and then take any number of questions from your side. The deposits. Now, what is the question asked in CARO? Let us understand this question. And then I told you that one who's practicing company law has to anyway understand the provisions of deposits. Or if you are a company CFO or a KMP, you need to know the provisions otherwise. But as auditors, I need to know from the audit perspective, how am I going to ask the question which has been posed in front of me in CARO? What is the question in CARO? It says, in respect of deposits accepted by the company or amounts which are deemed to be deposits, whether the directive is issued by RBI and the provisions of section 73 to 76 or any other relevant provisions of the Companies Act and the rules framed thereunder, where applicable, have been complied with. Now, let me explain this question. The one which is struck off in black is actually there in 2016 version. The one which is asked in red is the one which is asked in 2020 version. So in 2016 version, the question is like this. In case the company has accepted deposits from the public, whether the directive is issued by Reserve Bank of India and provisions of 73 to 76 or any other relevant provisions of the Companies Act and rules framed thereunder, where applicable, have been complied with. Now, you know what? Whether the company, in case the company has accepted deposits, now the word has been not only accepted deposits, but also deemed to be deposits. In fact, they have only, what should I say, what was implied has now been expressly asked. Earlier also, deposits included deemed deposits. Now they are only saying that you give me deposits and deemed deposits. So therefore, in spirit, although the words have got elongated in 2020 version, in 2016, it actually meant the words used in 2020 version. If not, the nature, so therefore, before I proceed to answer this question, I need to know what is 73, 74, 75, 76. And if not, the nature of contravention should be stated. If an order has been passed by the company law board, so I have to know what is the contravention before I answer this particular, what is a section, what is a contravention. Section I will know by reading the act and the provisions. Contravention I will know if I do the audit of that company and whether they have complied with the required conditions. If an order has been passed by the company law board or national company law tribunal or Reserve Bank of India or any court or any other tribunal, whether the same has been complied with or not. So that is an additional question which is asked. Now, let us be very clear. This is not told in camera, but before I proceed further, I want to say that this company's acceptance of deposit rules, or for that matter, section 73 to 76, is not applicable to a bank or a banking company, non-banking finance company, a housing finance company, and such other company as central government and Reserve Bank of India specific. So this is a point to be noted. So we proceed further. What are these 4 sections? Chapter 5 deals with acceptance of deposits from the company. And if there is one chapter which has prescribed the highest amount of penalty for non-compliance, it is this chapter. Now they are trying to protect the depositors, the gullible depositors. So therefore, if the company takes deposits, if the company, in fact, look at this. There is a difference between deposits and loan. If the company wants to take a loan, the company takes the loan. If the deposit is to be, deposit is always given. Deposit is always given to the company. Loan is always taken by the company. So loan, that is a fundamental difference between loan and deposit. I mean, very beautifully discussed. Deposit is always, to put it in a different way, deposit is given by the depositor. Given by the depositor for the benefit of the depositor. For the benefit of the depositor. Whereas a loan is taken by the borrower for the benefit of the borrower. I mean, that is how it has to be understood. And deposit may be for safekeeping also. Sometimes a deposit may be for safekeeping also. And deposit, in the case of deposit, it is a depositor who is the prime mover. In fact, the depositor gives an application to the company. That is how these sections are. The depositor has to give us an application. If you keep money with State Bank of India or any other bank, the bank will not give you an application. The depositor has to give an application signed and say, I want to give the money with, keep the money with you. In the case of loan, the borrower gives the application. So that is the fundamental difference between loan, deposit. And what is an advance? Let us understand in the same breath what is an advance. Advance is different from loans and deposits. Loans and deposit, I told you the difference. But in both the cases, money goes and money comes back. In the case of advance, money goes and comes back as goods or services. So advance for goods, supply of goods, or advance for services. So what comes back is goods or services, or in the worst situation or a very rare situation, the contract gets cancelled and the money comes back. In that context, the Companies Act says that advance which is given for a particular purpose, if the purpose does not happen, it could become deposits. So that is how the entire section is built up. So now let's see what is deposits. Deposit includes, it's defined in section 2 subsection 31 as, deposit includes any receipt of money by way of deposit or loan or in any other form by a company, but does not include such categories of amounts as may be prescribed in consultation with the Reserve Bank of India. So Reserve Bank of India tells, in fact, the guardian for the regulator for the banks which takes deposits is Reserve Bank of India. And therefore, Reserve Bank of India is sort of a quasi regulator along with the Ministry of Corporate Affairs for the companies which are taking deposits. So that is how we have to understand. So Reserve Bank of India is also playing a role because they don't want any company to be acting like a bank. Banks should play the role of deposit taking. And if it is taken by the companies, then Reserve Bank of India tells what are deposits, what are not deposits. Reserve Bank of India and MCA discusses together to say what are the conditions to be complied with before taking deposits. So that is how the importance of Reserve Bank of India. So it includes any money or receipt of money by way of deposit or loan or in any other form or in any other form. So that means any money taken could be a deposit unless it comes under the exempted category. Now you will see that I have used certain colors here, blue, red, and green. Now exempted deposits means green. Exempted deposits means green, which are specifically, I told you, may be prescribed in consultation with Reserve Bank of India. There are about 18 categories of monies collected, loans and advances and deposits collected by the company, which will still not be considered as deposits because they have been told as Rule 2(1)(c) says these are not deposits. Money include any deposit except the following. So what are those exceptions? Exempted category, 18 categories have been told to be. Now any money, let me now tell you, any money collected as deposits could be after complying with the condition. After complying with the condition. Then if you comply with the conditions to collect deposits, then you are in the blue zone, safe zone, blue zone. If the money collected is in the exempted category, then you are in the green zone. That means you are in the safe zone again. If it is neither blue, that means money collected royally as deposits, complying with all the conditions, or money which is in the green category, which is exempted category. If it is money collected not falling in the blue category, not falling in the green category, then it falls under the red category. That means that is the most dangerous category, which calls for penalties and prosecutions. So therefore, we have to see what are those green, what are those blue, and anything which is not blue or green will become red category. So either it could be deposits. Look at this. Either it could be deposits or it could be deemed deposits. What are deemed deposits? You will see, for example, green deposit. In one of the concepts of exempted deposits, they say advance collected from the customer up to 365 days. Up to 365 days is green deposit, exempted deposits. But the moment that advance is remaining with you for more than 1 year, it becomes, you may not have collected it as a deposit. You may not have collected it as a deposit under the blue category, but because it is not anymore a green category, it will fall either under the blue deposit or it could fall under the red deposit. That means it could become a deemed deposit, then for which I have to comply with the conditions, or it could become the deemed deposit could be a contravention in itself. So any deposit or a deemed deposit which is in contravention of the conditions told can attract penalties, can become red in that particular context. So section 73 says prohibition of acceptance of deposits from the public. Who is prohibited? Normally a company cannot take money from the public. A private limited company cannot take money from the public. Acceptance from members, that means from the shareholders, is okay, subject to certain conditions under section 73 subsection 2. And provisions not applicable to banking companies, NBFCs, HFCs, central government specified companies. So acceptance of money from the shareholders is okay, even in a private limited company or a public limited company. But money taken from shareholders is not money taken from the public. So section 73 tells that you can take money from the shareholder subject to certain conditions. We'll see what the conditions are. 74 says if you have collected any deposits which were okay under 1956 Act, but now it is considered to be neither a blue deposit nor a exempted deposit, then you must repay that deposit within 3 years from 2013. The Companies Act 2013 came from 1/4/2013. That means within 14, 15, 16. By 31/3/2016, I should have returned this money. And there are certain conditions which had to be complied with, filing certain forms, which I am not talking about that. If you did not do that, there were certain penalties. Section 75 says if you have collected this money by fraudulently, then you are supposed to not only pay the penalties and prosecution subject to officer in default to prosecution, you may also have to make good the losses or damages which may be incurred by the depositors. So under the red, there can be two types of red. One is light red, one is dark red, if I may have to use that. So the light red means only penalties and only imprisonment. Only imprisonment. But then along with penalties and imprisonment, in the case of fraud, the person who has suffered the loss also, the loss has to be made good. So that is 74, 75. 76 is again getting into the blue deposits, which is a eligible public company can collect monies from the public, by complying with certain conditions, stringent conditions. I call it as stringent conditions. So who can comply with this? Eligible public companies. Who are eligible public companies? If the public company has a net worth of more than 100 crores or turnover of more than 500 crores, they are eligible. And they have to comply with a host of conditions, which we will see. I will not cover that in detail because in a session like this, those type of companies can anyway look into the provisions, hire the best of the professionals and comply with that. Most of the private limited companies or unlisted public companies can come only under section 73, which I will be dealing in detail. So 73 and exempted deposit, we will see what are the conditions. And 76 compliances has to be only far and few. They have to come out with the newspaper advertisement. We will see. Hawkins has come out with the newspaper advertisement last week. I will show you now. They have to give a detailed compliances have to be complied with, which we will not cover in a session like this. What is 76A? 76A says punishment for contravention of 73 to 76. If any of these provisions are not complied with, that means blue, you have taken deposit from members or from public, and you have not complied with the conditions, or it is not a green deposit, so therefore it becomes a red deposit, then the punishment and the penalties are so huge. What is the penalty? For the company, it could be 1 crore to 10 crores of penalty. For the officer in default, it is 25 lakhs to 2 crores, and there will be a 7 years imprisonment of the officer in default. And all the non-compliances, please note, we have seen also this question. We as auditors have been asked to be the guardians of this particular provisions. We have to say whether the provisions have been complied with, yes or no. That is how we become as auditors responsible. So penal consequences, we have already seen this. I'm not talking about it in detail, but one point in between, damages may be claimed through class action suit under section 245. This is a new section 245 is a class action suit, which a group of shareholders, a group of depositors, or a group of people who have been affected can join together and lay a claim against a group of directors, a group of management people, including the auditors. So by requisite number of depositors, if the company's affairs conducted in a prejudicial manner against the company, against the auditor or firm of auditors, for improper or misleading information in the audit report. So I wanted to highlight that a class action suit under section 245 against auditors or a firm of auditors who have not probably disclosed the non-compliances in a CARO report. So that is the seriousness with which this particular chapter has been set up by the committee on KSCA for educating the chartered accountants. So this is one pictorial representation of what I just now told. So money received could either be not a deposit under Rule 21C, or it could be a deposit after complying with the conditions as told in the rules. Then if it is deposits, it could be either from members, that is the shareholders, or from non-members, which can be taken only by eligible public companies. From members, even a private limited company can take, or a public limited company can take. In the case of a private limited company, all private limited companies can take money from the shareholders up to 100% of its net worth, of the company's net worth. And if they want to take more than 100% of the company's net worth, they have to comply with 3 conditions. That is, it should not be an associate or subsidiary company. The company which is collecting should not have an associate company or should not have a subsidiary company. The company should not have borrowings from banks, financial institutions, and body corporates divided by paid up capital of more than 2, or less than 2. The banks borrowings from banks, BFC divided by PUC should be less than 2, or their total borrowing should be less than 50 crores, and no default in repayment of such borrowings. And if it is a public limited company, it can collect from members only up to 35% of its net worth. And from non-members, they have to comply with section 76. Otherwise, you see at the top right hand, they will be subject to contravention. It will be called as a contravention, for which there are penalties and prosecutions both on the companies and on the officers in default. Now let's get into what that exempted category is. What that exempted category, 18 exempted category. Deposit includes any receipt of money by way of deposits, by way of deposit or loan or in any other form by a company, but does not include any amount received from 1 to 18, central government, state government, local authority or statutory authority. In fact, this 18 points, if you look into the company's rules, it will run into 5 or 6 pages in very small fonts. Very difficult. But then I've tried to capture everything in one particular slide here. Central government, state government, local authority or state authority. Number 2, any money taken from any foreign entity or a foreign person, as long as it is okay from the point of view of Foreign Exchange Management Act, FEMA, as far as it complies with FEMA, then if it is good for FEMA, it is good for Companies Act. It is considered as green. Then loan or facility from the bank. Any money which is taken from a bank, either as loan or in the form of any facility from banks, is considered to be green deposit. Loan or facility from public financial institutions, that is KSFC, KSIDC or any such equivalent. Commercial paper. Now, 6th point is very interesting. 6th point, please note this. I have underlined certain very important points. 3rd point, 6th point, 8th point, 11th, 13th and 12th. So these are very important points which everybody will have. Any other company. So any money taken from any other company is considered to be an exempt deposit. So that means if my company takes from any other company, then that is also, so this is what we technically call it as intercorporate deposits. While the giving company has to comply with section 185 and 186, the taking company is free to take money and call it as an exempt deposit always. Now, point number 7, share application money up to 60 days. Now, within 60 days, if the shares are not allotted, it becomes red. Up to 60 days, the company can keep it as share application money, and within 60 days, if it is not able to allot, 15 days from the end of 60 days, it has to return this money. Otherwise, it will become a red deposit. Now, green deposit also includes, that is exempt deposit also includes directors subject to a declaration. What is the declaration? That they should give a declaration that this is not out of borrowed funds. It is not out of borrowed funds. Now, relatives of directors can also give money only, and it can be considered as exempt deposit only in the case of a private limited companies. So let me put it this way. Directors, in the case of all companies, it is exempt. Relatives of directors only in the case of public limited companies, in the case of private limited companies, is exempt. But both of them, directors and their relatives, in the case of private limited companies, should give a direct declaration that this money which they are bringing into the company is not out of borrowed funds. So what the company cannot do directly, the directors cannot do and put in indirectly. So that is how the thing has to be seen. So point number 9, debentures are not considered to be exempt, provided those debentures are listed, or those debentures are fully secured, or those debentures are compulsorily convertible within 10 years. So then only then those debentures will be considered as exempt. So I'm not talking about that otherwise. Next, any amount taken from an employee of a company up to 1 year of his annuals, up to 1 year salary of that particular employee, I could have taken it as a security deposit, which is exempt. The 11th one is very interesting, non-interest bearing amount and held in trust. So any amount held in trust by the company, which is non-interest bearing, will be considered as exempt. Then 13th point, unsecured loan from promoters, if and only if stipulated by the banks. So unsecured loans from the promoters, if and only if stipulated by the banks, as long as the bank loan is there, this will not be considered as exempt. Now, two things, for this there is no condition. Now, what is the difference between item number 13 and item number 8? In the case of item number 8, only directors. In the case of 13, they can be promoters without being directors. Point number 2, in the case of directors, they have to give a declaration. In the case of 13, these promoters could also be directors. They could also be directors, and they need not give a declaration that it is out of borrowed funds. So that is a benefit, because it is brought in not to satisfy the company, but to satisfy the conditions as given by the external bank. But this amount has to be returned the moment the bank loan is closed. So that is how this has to be read. Except any amount accepted by Nidhi companies And point number 12, any amount received in the course of or for the purpose of the business of the company as advance from customers. So this is how, sometimes the chapter on deposit looks like it is too much in favor of the gullible depositors, sometimes against the company which is taking genuine funds. The MCA or the regulator is not able to make a classification as to what is genuine and what is not genuine. So therefore, he said any advance from customer up to 365 days will be considered as genuine. After 366th day, it will be deemed to be deposit. And the moment it is deemed to be deposit, if you are not complying with the conditions of deposit, then it will become a red deposit. Advance for immovable property. Any amount taken as advance for sale of immovable property as per the terms of the contract will be considered as exempt deposit always. It can be held for more than 365 days also. Any security deposit which is taken under contract or advance taken for long-term projects. Now, if I'm manufacturing a ship or a dam or a aircraft, which normally takes more than 365 days for me to generate a bill, but I'm collecting the advance from my customer and supplying the goods, which is a capital goods from the buyer. In fact, the rule uses capital goods, from whose point of view it is not told. Obviously, it cannot be capital goods from the seller's perspective. It has to be capital goods from the one person, which is the buyer. So therefore, I presume capital goods is from the point of view of the buyer. So advance for long-term projects, again, there is no cutoff of 365 days. Advance for future services towards warranty, maintenance contract as per written agreement or arrangement, as per normal business terms, or up to 5 years, whichever is lower. So this could become for future services. In the case of if you buy a car, they will say 3 years service warranty, we collect in advance, up to 5 years, whatever money collected towards future services. It could be annual maintenance contract or 5 years maintenance contract will not be attracting the provisions of deposits. Advance received and allowed by sectoral regulator or with the central government or state government directions. Advance for subscription towards publication to be adjusted against receipt of such publications. Now, if any magazines or newspapers are collecting future subscription amounts, it will not be considered as it will be an exempted deposits as long as they are adjusting against the sale of publications. Chit funds, chit subscriptions, collective investment schemes, and more than 25 lakhs in a single tranche by startup companies as optionally convertible debt. Alternative investment funds, etc., registered with SEBI is also considered to be exempt. So this is these are the 18 points which comes to the rescue of the company. Now, what could be one of the interesting issues? What happens if the company takes advance from another company for sale of goods which are held more than 365 days? Which are held for more than 365 days. It is advance taken from another company. Very interestingly, we can put it under item number 6 and say this is a money received under any other company, that is intercorporate deposits. I mean, it doesn't use the word, the rule does not use the word intercorporate deposit. It says money received from any other company is considered to be an exempted category. Now, the point that is tried to be explained, or the ethos, or the the greater objective is such a company which is giving cannot be a gullible investor. A gullible investor is an uneducated or probably not so naive, not so familiar with the provisions of the law. He may be naive. So a company cannot be naive, or a company cannot be taken for a ride by another company. So therefore, they feel that any money given by a company, even if it is an advance for supply of goods, can as well be put under any other company heading under column number 6 instead of under column number item number 12. So the last point to be noted is following to be treated as deposit. Any amount received, whether in installments or otherwise from a person, with a promise to offer to give returns in cash or in kind, or completion of the period specified in the promise or offer or earlier, accounted for in any manner whatsoever. So if I've just collected it in chits or installments, promising him to give something else in return, later on, something like a chit business which I am doing and not being a chit company itself will also be considered as deposit. Any additional contribution over and above the amount under item A above made by the company as part of such promise or offer. So these are the exempted deposits. One which is given in red is the not exempt in that particular sense. So we have to understand who is a relative. We talked about directors and relatives of directors. I just have to say relative has to be seen from the point of view of Companies Act, which defines relatives as aju baju, aage piche, just upar, just niche. Now in Income Tax Act, I always use this aju baju, aage piche, upar niche. So lineally ascendant, lineally descendant are relatives in Income Tax Act. In Companies Act, my grandfather and grandparents and grandchildren are not relatives. So if a director has taken money from his grandfather and given it to the company, or a relative saying that he's a relative of a director, then the auditor has to say that that is in contravention. It is not an exempted deposit. So who are all relatives under the Companies Act? Aju baju, that means husband and wife. Aage piche, that means brother and sister. Just upar, mother and father. Just niche, son and daughter. And in Companies Act, they have brought in two more relatives, that because they removed grandparents and grandchildren, they brought son's wife and daughter's husband. So I call them as son in company law, daughter in company law. So these are the son-in-law and daughter-in-laws of the person, of the director, can also bring in monies subject under item number 8. So that's the point to be noted. Debentures, we have already seen. Formators, acceptance of deposits by the companies prior, you'll have to anyway return. So now let's talk about, we've already seen this, acceptance of deposits, relaxation to private companies. I will talk about only the last one today. With effect from 15th of September 2019, a company could take money from the directors and relatives of directors. And I have given a hash subject to declaration that it is from own funds. We have already seen. This is in the case of a private limited company, even from relatives of directors. And subject to declaration that it is from their own funds and disclosure in the financial statement as notes and in board report. So when it is taken from a director or a relative of a director, there should be a declaration that it is from own funds, and in the financial statement there should be a disclosure that it is taken from relatives of directors, and the board report also should give that particular disclosure. Then members, shareholders up to 100% of the paid up capital plus free reserves by filing DPT3. Anyway, DPT3 has now got to be filed for every case. We will see this. So deposits can be taken under section 73 subsection 2. Again, we have seen this, but put it in a proper table to say under 73(2) from members by issuing a circular. Okay, 73 subsection, any company can take it. And circular also, there is an exemption for private limited companies. 76 deposits, which is only by eligible public limited companies. It can be taken from non-members, that is from public, by issuing a circular, which is in the form of an advertisement. Both of them has to be, if any deposit has to be collected, I'm calling it as blue deposit, that is compliant deposits. It could be exempt deposits, compliant deposits. So if it is none of them, then it becomes a red deposit, a non-compliant deposit attracting penalty. So a compliant deposit can be either from members, shareholders, or from public. Both the cases, it is a compliant deposit only if it is passed as a resolution, subject to passing a resolution in the general meeting. Company cannot collect deposits without passing a resolution, without going through the members. So acceptance of deposits from members, wide section 73 subsection 2, even a private limited company can take it. Public company up to 35% of the net worth, private limited company up to 100% of net worth. For private companies, maximum limit not applicable if and only if, that means we already saw, certain private limited companies can take up to 100% of the net. All private limited companies can take up to 100% of the net worth. If it is more than 100% of the net worth, then they can take subject to the following conditions. What is this? If it is a startup company approved by the DPIIT for the first 10 years as per notification dated 7th September. Today we are on 22nd September. 7th September there was a notification which increased from 5 years to 10 years for a startup company. Other than the startups, if all the conditions below are complied with, we already saw that company is not an associate or subsidiary. Borrowings from banks, financial institutions and body corporates divided should be less than 2 times the paid up capital, or such borrowing should be less than 50 crores, and no default in payment of borrowings while accepting the deposits. What are the action points required? File DPT3 every year before 30th June. take an application from the depositor, and that member should also give a declaration that it is not out of borrowed funds, that we have seen, and passing of the resolution in the general meeting. Apart from these 4 points, if it is a public limited company, they have to comply with the following additional conditions, which is shall issue circular to all its members in DPT1 after approval in the board meeting, may publish above circular in the newspaper, not a must, they may or may not, shall deliver to the register of company copy of the circular 30 days before its issue, auditor certificate regarding no default in deposit repayment in the past attached to DPT1, and deposit in a separate bank account before 30th April, 20% of the deposit maturing following year. On the last condition, there has been certain relaxation for COVID. So these are the conditions. I told you section 76 is to be collected only by eligible public limited companies complying with certain conditions. I'm not getting into the details of this. Recently, I think last 4 days back, there was this Hawkins Cookers Limited, which came out with this particular circular in the form of advertisement, a whole page of circular conditions complying with, giving attractive rate of interest of 12%, locked in for 5 years and things like that. Other rules to the depositors, I'm not getting into this. Yeah, I'll wind up by saying every company which has either a green deposit or a blue deposit, either a green deposit, exempted deposit, or a compliant deposit, or non-compliant money taken, which is a red deposit, has to file every year a form called DPT3. DPT3, one time is already gone. I don't want to talk about that. If it is only deposits, if the company has only compliant deposits, it has to tick the radio box number 2 called the return of deposits, because it is only one form which has got 4 radio box. You have to tick what is applicable to you. If you have only blue deposits, you tick the second column. If you have got only exempted deposits, you tick the third radio box, which is particulars of transaction by the company not considered as deposit under Rule 21C. If you have both blue as well as green, that means your private limited company has taken members' deposits from the shareholders, that 100% or beyond subject to certain conditions, or exempted deposits, that 18 deposits, then in that context, you have to tick item number 4. And if you have ticked item number 2 or item number 4 in that particular DPT3, it has to be certified by a chartered accountant, saying that all the conditions required to be complied with, taking that money has been complied with. So no prescribed format for auditor certificate, audited figures not mandatory for e-form DPT3. Amount outstanding in DPT3 shall include both principal and interest. Loan received from directors during his tenure, but later on resigned as director. At the time of giving the money, he was a director, and later on he resigned, but the money continued with the company. Amount outstanding considered as exempt deposit. There's no problem. Okay. So DPT3 not as STP form processed by officials of MCA before approval. The banning of unregulated deposits, I will not go. I will take one question before I get into related parties. Santosh, are there any questions on DPT?
Sir, we have many questions as to what constitutes a deposit. I think it's well clear in the slide.
Yeah.
Yeah. So we have a question as to whether the share application money which is held for more than 6 months without allotting shares shall be constituted as a deemed deposit.
Yeah, I think Santosh only can answer that.
Yeah. So it was pretty much clear in slide 16.
No, I want you to answer that, whatever.
Yeah. So anything which is post 60 days is considered as a deemed deposit.
It is considered. It's considered. It's considered deposits. Yes, perfect.
Yeah. So we have a general question which asks that in case where we are supposed to prepare financial statements of previous year, say from financial year 2010 onwards, should we adopt the Companies Act 1956, the CARO provisions and the essays which are existing for the financial years, or as on the current date?
Okay, I mean, I'm very surprised as to why anybody from 2010 has not done. In any case, the person this must have a case like that. In that context, it should be as applicable in that particular year. We don't use the current year. Even for that matter, when we talk about 2020 CARO when it came, or 2016 when it came, if you are doing 2015's financial statement, you should adopt the CARO as applicable to 2015. Don't use the latest form. Yeah. Next. Any more questions, Santosh? Yeah, I think Santosh is out. I will proceed with my next silo, which is related party transactions. On related party, there is a general notion. I mean, when I was talking to a few chartered accountants, they were saying that I thought that related party compliance, as far as the auditor is concerned, he has to look into only the accounting standard 18. Whereas CARO, let me tell you, CARO is very harsh. It talks not only about the disclosure of AS 18, whether the AS 18 related party transaction disclosures have been made. Related party disclosures are only for disclosing in the financial statements. Whereas section 188 talks about a detailed compliance as far as the related parties are concerned. It has to go through a lot of compliances, which we will see. And I, as an auditor in CARO, have to answer whether all those compliances have been complied with. If not, I have to bring out what are the non-compliances. Therefore, as an auditor, I am supposed to look not only into AS 18 related party transaction disclosure, but I also have to look into 188 compliances, whether it is properly complied with, or if there is any non-compliance, I have to bring out all those non-compliances in my main audit, in my CARO report. Now, what is the question in clause number 13 of CARO? Whether all transactions with the related parties are in compliance with section 177. 177, you will see, is applicable wherever there are audit committees of the board. So it's a section which says when an audit committee of the board is there required, when it is required to be there, and if an audit committee of the board is there, then what all the transactions with the related parties has to be approved by the audit committee of the board. That is what is 177. Normally in private limited companies, an audit committee of the board is not required. 188 is related party transactions, also applicable to private limited companies. So whether all the transactions, I have just tried to slice this question. Now, if you read the question, for that matter, even if you read deposits, if you read related party in the Companies Act and the rules, it will not be as interesting as it is there in my presentation. You know, once you read this presentation, you will feel a I mean, as to simple, I'm trying to make it as simple as possible. You know, the very question that is asked in CARO, it looks like it is one question, but actually there are two parts to this question. It asks like this: whether all transactions with the related parties are, point number one, in compliance with section 177 and 188 of the Companies Act where applicable. And second bit of the question, the details have been disclosed in the financial statements, etc., as required by the applicable accounting standards AS 18. So there are two parts to this. So I will carry on with this discussion in a short while. But before that, I wanted to talk about the importance of chapter 12, meeting of the board of directors. Now, if there is one more chapter which is as important as chapter 9 and 10, we talked about 9 and 10. 9 on accounts and 10 on auditors. The next chapter which becomes very important is chapter 5, which we just now saw, deposits. Now we are talking about chapter 12, meeting of the board and its powers. And there are about how many? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20, 21 plus 2. Two sections have been abolished. 194, 195, they have removed it. In Companies Amendment Act 2017, because they were dealing with forward dealing and insider trading, which is applicable to listed companies, and what is applicable to listed companies anyway is covered in SEBI. So therefore they said two acts should not control one problem. So they have removed this from Companies Act and shifted it to, retained it in SEBI. So we have now 173 to 193, 21 sections. 173 dealing with board meetings, how often they should be conducted, who should be present in that board meeting. And 174 deals with the quorum for board meeting. 175 deals with passing of the resolution by circulation. What can be done by circulation, what cannot be done by circulation. 176 defects in appointment of directors not to invalidate actions taken. So what does this 175 say? 176 says that once you are posing as a director, the theory of promissory estoppel will come into place, that the other person who believed that you are a director cannot be said later on that my appointment was invalid and therefore what actions I did was not to be considered at all. So the person who believed you and you posed as a director, other directors also said you are a director, and he acted in good faith and given some money or whatever, did some transactions, and then finally this appointment was proved to be defective, that defect cannot be in defense of the company. So that's what is told in 176. 177, I told you, very important section, audit committee, when an audit committee is required. And if an audit committee is there, what are all the things that should be placed before the audit committee is very important. And since we are talking about related party transactions, which is told in 188, 188 talks about related party transactions, and you'll be very shocked to know there are related party transactions and transactions with related parties. Two different things. All transactions with related parties are related party transactions, but there could be some more transactions with the related parties can be of two types: related party transactions and other than related party transactions. What is covered under 188 is related party transactions, you will see, but there are other transactions not covered under 188 which still would be transactions with the related parties. That will be the other party. So we will see all transactions with related parties has to be approved by the audit committee. That's what I wanted to say and stop. Further again, I'll reiterate later on. Then there is 178, which talks about nomination and remuneration committee and stakeholders relationship committee. In fact, I was fortunate to be the chairman of this committee in one of the board of directors. So what this particular committee does is they are the ones who will get the various people who nominate directorship. I'll have to study the fit and proper status of that particular proposed director. I'll also have to see whether the variable remuneration given or the remuneration that is being given to the directors are within that 197, 198 cutoff, things like that. Stakeholder relationship committee. What are the complaints with the stakeholders and how are they getting resolved is what is to be seen by them. Then powers of the board. 179 talks about what are all the various powers of the board. It is in a sort of a rights of the board of directors. 180 talks about restriction on the board powers. What are the restrictions, the duties? I mean, what is the maximum up to which the board of directors can go? 181 talks about company to contribute to bona fide charitable funds. 182 talks about prohibition and restriction regarding political contribution. 183 talks about powers of the board, other person to make contribution to national defense fund. There are certain restrictions which are told there. Then 184 is a very important section when we talk about 188. Disclosure of interest by directors. Every director in the first board meeting of the year, which happens in April, should give the list of directors, a list of entities in which he is interested. Because if he doesn't give this, let us say the company will not know. So there is a company secretarial department of the company that will have to collate the information as given by the director. So we call that as MBP1. In MBP1, the director should disclose which are all the entities in which he is interested and who are all my relatives. So the list of related parties and the entities will have to be given by that company to the director every year on the 1st of April. Whenever there is an appointment of a new director, immediately in the first board meeting he has to give, or whenever there is a change, addition or deletion in the related party entities, he has to give a MBP1. That is told in 184. 185 deals with loans to directors, whereas look at this, what we just now saw, 72, 73, 74, 77, the deposits were amount collected. So amounts collected from anybody is restricted, from directors is okay. But once the company is formed, amounts given to the directors is considered as bad. You look at this, a company can take money from directors, but a company cannot give money to directors having collected it from so many people. So that is why there is a restriction on the loans to directors or the companies in which the directors are interested. 185. Loans and investment by the company in general. It could not necessarily be the interested directors. What are the maximum amount? What are the conditions before which a normal company has to comply with when it is giving loans or making shares or giving securities or starting as a guarantee on behalf of somebody's borrowing is told in 186. 187 deals with investment of company to be held in its own name. When it says that all shares or securities, all financial instruments will have to be held in the company's name, own name. 188 is what we are going to talk about, related party transactions. 189 is another very important thing. Once I give 184 declaration in MBP1, it becomes the responsibility of the secretarial department to make a note of all these MBP1 in a register of contracts or arrangements in which the directors are interested. Now look at this. The word used in 188 is related party transactions. Transactions with the related party transactions could be of two types. Either those transactions are on formal and written basis, in which context it will be called as contract. If it is informal and not in writing, then it becomes an arrangement. So throughout you will see in 188, they don't use the word transactions, they use the word contracts or arrangements. In my future presentations, you will see C bar A. C bar A does not mean chartered accountant, it refers to contracts or arrangements. So contracts and arrangements together become transactions. So related party transactions, therefore I maintain a register of transactions in which directors are interested. Or register first maintains which are all the entities in which he is interested, and if there are any transactions, those transactions should specifically be listed out under that particular entity. Then, and that 189 is a document which can be seen by any member of the company. So 190, contracts of employment with the manager, managing or whole-time director. 191, payment to directors for loss of office. 192, we have that in Caro, restriction on non-cash transactions involving directors. 193 is contract by one-person company. In the case of one-person company, he is only one director. So however the things to be done in such a situation is what is dealt in. Referred to in Caro. So out of this chapter, 1, 2, 3, 4, 5, out of 21 sections, 5 sections have to be commented upon in Caro, what we already saw. So a very important chapter that way. So which we will proceed today. In the next 20 minutes, I will try to complete related party transactions and then open it up for questions. Although I may be a bit fast because 188 itself is a 1 hour session. I mean that if one has to get into the details, but I presume that most of you are aware of this, and those of you who are not aware, you can go into my detailed lecture which I've given it on SARC last Sunday, I think on 13th of September. I gave a presentation on this for 3 hours, deposits and related party transactions, where I've gone word by word, so one can get into the details of that. But here let me concentrate quickly on what is the difference between 188 and AS 18. 188 defines what is related party transactions, whereas AS 18 gives me a broad principle as who is a related party. 188 is very objective. It says who is a related party, etc. Whereas AS 18 related parties are subjective. In section 188, I have to give a disclosure in the board report as an annexure called as AOC2, whereas AS 18 related party transactions has to be disclosed in the general purpose financial statement itself. So while one is covered in board report, the other one is covered in financial statements. 188 is both compliance and disclosure. AS 18 is only disclosure. Compliance in the case of 188 will be concurrent. That means every time a transaction happens, we have to see whether the compliance is there. But then disclosure happens only at the year end. In AS 18, of course, the disclosure only, so therefore the disclosure is only year end. And in section 188, no disclosure required if no related party transactions entered into. Whereas in AS 18, disclosure is required if control exists irrespective of the related party transactions. That means I have to say under AS 18, 2 things. Entities in which I am controlled or I am controlling, the list of that has to be given irrespective of whether there are transactions in the year or not. Whereas entities in which I have significant influence or which is exercising significant influence on me has to be given only if there are related party transactions. So control entities has to be given in AS 18 irrespective of whether transactions are there or not. So this is one slide which will explain who, what is the gist of 188. So let me just try to explain that in one shot. Companies entering into contracts or arrangement with related party. That is a question I asked, whether there is a contract or an arrangement. In short, contract and arrangement means a transaction. I already told you. If the transaction is in writing and is formal, then it is contract. If it is done without a writing or it is being done informally, then it is an arrangement. So companies entering into contract or arrangement with the related party. So this is particular question I will ask to every company, including a private limited company. So that the question comes is, who is a related party? I will have to ask, who is a related party. So that I will answer first. Related parties, let me tell you, there are nine types of related parties as defined in section 2 subsection 76. 9 types, which could actually become 31 types. Let me explain what that is. So a related party could either be a director or the relative of a director. So while it can be one type, but a director is one relative and the relative of a director could be another type. Within that type 1, there can be 2 types. So we have given 2 at the right hand column. Then the key managerial personnel. So we have also seen who the relative is. Relative means aju baju, aage piche, just upar, just niche, son-in-law, daughter-in-law. So that is how the definition of relative. Key managerial personnel. Who is a key managerial personnel? A key managerial personnel could be either a CEO, a company secretary, a whole-time director, a CFO, one level below the director if they are nominated as such other officer not more than one level below the directors who is in whole-time employment designated as KMP by the board. Such other officer as may be prescribed. And CS, you know, today every company having more than 10 crores have to appoint a company secretary. So key managerial personnel or the relative of the key managerial personnel. Let us say a CFO. His aju baju, aage piche, just upar, just niche, son-in-law and daughter-in-law could also be the related party as far as the company is concerned. So while second type, there can be 2 types. That is a key managerial personnel and relative of key managerial personnel. Third one is firm in which the director, manager or his relative is a partner. So how would I read this? Firm in which the director is interested, firm in which the manager is interested, firm in which the relative of the director is interested, or the firm in which the relative of the manager is interested. So that is how it becomes 4 types of transactions there. And the 4th point is private companies in which directors or manager or his relative is a member bar director. Now, in the case of a private limited company, for this company, director, let us say private company in which director or manager or his relative is a member. That means in this company, I am a director, and another private limited company, I am just a shareholder, or I am also a director. I am just a director. In that, then these 2 companies are said to be related parties. Whereas when it comes to a public company in which the director, manager is a director in the other company, just by me holding shares in a public limited company, that these 2 companies will not be a related company. So in the case of a company, a public company will be considered as a related party if my director is also a director and holds more than 2% of its paid up share capital. So that is how it is to be seen there. Then 6th type of relationship, any body corporate whose board, managing director, manager is accustomed to act in accordance with the advice, directions or instructions of directors or manager. 7th type, any person on whose advice, directions or instruction a director or manager is accustomed to act. And this person need not be a director. Look at this. He is controlling the board, not being any it is type of Benami type of a transaction one can think of. I don't want to be the director, you be the director, but I'm controlling the directors. So that person who is not holding any position, but he is the one who is whose advice, directions or instructions the director or manager is accustomed to act is also considered to be a related party. Holding company, subsidiary, associate, finance company, holding company, subsidiary company, associate company, fellow subsidiary, investing company, venturer company. All these are considered to be related parties. Such other person, and in the case of a private company, holding subsidiary, associate, fellow is not treated as related party transactions. So let us be clear. In the case of a private company, its holding company, its subsidiary company, its associates and fellow subsidiary is not treated as related party transaction. Such other person as may be prescribed, they have prescribed only one person, director other than independent director or key managerial person of holding company or his relative. Whenever the Companies Act says as may be prescribed, then I have to go and see the rules. The rules are for the moment prescribed only the director other than independent director bar key managerial personnel of not this company, but of the holding company or his relative has been defined. So these are the various related parties. First, I have to see if the transactions are done with those related parties, the 9 type of related parties. If the answer is no, then no action required under 188. If the answer is yes, I will have to see ordinary, whether it is done in the ordinary course of business and at arm's length. Now, this is $1 million question. If the transaction is done in the ordinary course of business and not at arm's length, that means whatever the transaction is being done, normally the company does this type of transaction, and the payment that is being received is whatever is received from the customers or any other person, the same amount is being received, then it is considered to be at arm's length. I mean, our institute has given a lot of guidance because we have to answer this in the CARO report. So guidance note on CARO has given an elaborate explanation as to when you will consider it as ordinary course of business. What is an arm's length? How do you determine arm's length? The company should give you all assistance to determine that. But you have to independently verify whether what the company says is right. So if these two conditions are complied with, although it is a transaction done with a related party, it will not be considered as 188 types. So no action required under 188, but disclose in the director's report. Disclose in the director's report. If the answer is no, that is not in the ordinary course of business and at arm's length. If the answer is no, it is not in the ordinary course of business, or it is in the ordinary course of business but not at arm's length, any one of them breaching, then it will be no. Then whether it is related party transactions as stipulated. Now they have given, if you look at this, they have given about 7 types. There are 9 types of related parties, 7 types of transactions which are covered under 188. That is why I said anything out of these 7 types with those related parties are transactions with the related parties, but not related party transactions under section 188. Now I will explain what that is in some time. So 188 talks about only these transactions, whether it is sale of goods or materials, whether it is purchase of goods or materials, whether it is supply of goods or materials. That means mostly concentrating on movables. Gaurish, we are at 6 o'clock.
Sir.
We are at 6 o'clock.
Yes, sir.
Can I have the liberty of taking it forward?
Another 10 minutes, sir. How much time it would take?
I can stop in 1 minute also. I mean, I can stop right now.
There are 28 questions, sir.
We will answer all of them.
Okay.
Who wants to log out can log out afterwards. But then anybody interested, we should give them whatever they have asked for.
Yes.
Okay. Then I will do one thing. I will close it up in the next 10 minutes very quickly.
Okay.
Then open it up for the questions. Okay.
Yes, sir. Okay.
One is sale, purchase, or supply of goods or materials. That means movable. The second type of transaction that they're talking about is selling, disposing, buying of property of any kind, that is dealing with immovable property, leasing of property of any kind of the company, or the company is leasing of that of the promoter, of the related party. Either it is taking or giving the property on lease, availing or rendering of services, appointment of agent for purchase or sale of goods, material, services, or property, appointment to any office or place of profit. Office or place of profit is a very important terminology which we use, other than director's remuneration. Underwriting subscription of securities by derivatives of the company. So these are all considered, these are the 7 transactions which are considered as related party transactions. So we go back. If they are not of this, now if you see related party transactions, what are those transactions with the related party not covered in these 7? Mostly it could be, if you see in these 7 parties, there are only goods, movable goods, immovable property, leasing of renting, services, agency, office of place, finance transactions, deposits, remuneration. These are not covered under 188. This is exactly what I said. These are transactions with a related party, but not related party transactions under section 188. So that is the point. So related party transactions are only these 7 which we just now discussed. Then we'll say if they are related party transactions stipulated, if the answer is no action required except disclosure in director's report. If the answer is yes, we'll have to check whether the limits have been breached. There is a 10% limit breach. There is a 10% limit breach. So let me talk about what the 10% limit breach is. So this is how they said. Now, for sale of goods, 10% of the turnover. If I'm buying anything more than 10% of my turnover or selling anything more than 10% of my turnover, then it breaches that particular limit. If I am buying a property or selling an immobile property more than 10% of my net worth, then it breaches the limit. Similarly, leasing of property of any kind, 10% of turnover. Availing or rendering of services, 10% of turnover. So mostly it is linked to turnover, except for buying and selling of property, which is a balance sheet item for which net worth becomes the basis. And appointment to any office or place of profit in the company, subsidiary and associate company, if the monthly remuneration is more than 2.5 lakh rupees. Underwriting subscription of securities or derivatives, remuneration is more than 1% of the net worth. In fact, earlier, I think up to 18/11/2019, that means up to 18/11/2019, there was one more thing which we had to see, 10% of turnover or rupees 100 crores, whichever is lower. So they said we will remove the monetary ceiling. Imagine Reliance or Piramal or some big companies, if they had to go for, if there is a breach, they have to go to the general body meeting for every time for getting the approval. If there are any related party transactions of 101 crore in Reliance Industries Limited, where 101 crore happens to be a round of difference, they should have gone for a general body meeting for getting an approval. So now they said, if it is more than 10% of the turnover only, you have to go. If it breaches 100 crores, you don't have to go. So that's monetary limits have been removed. Only percentages have been. So that way it makes for larger companies, the cutoff will be larger in that sense. So one has to look into the limits breach. If the answer is no, then a board consent and a board disclosure in the board report. If the answer is yes, if it has breached the limit, then they have to go and not only get the board consent, but also get the prior ordinary resolution, approval from the shareholders in an ordinary meeting. What are the other provisions to be considered? Elaborate disclosure in the notice of board report, a board meeting, and explanatory statement in the general meeting which calls for this particular transaction. They have to give what the transactions are. Then interested directors and members not to vote at the board meeting or ordinary resolution, which is not applicable to private limited companies. And there is a rule of 90%. Even in public company, if 90% of the directors are interested, they also can vote after giving the disclosures. So default of any of these provisions will make the contract or arrangement voidable at the board's option or at the shareholders' option, as the case may be. Another point to be noted here, if the company has an audit committee, then audit committee of the board to approve all transactions with related party. Very clear. It is. I'm not using the word all related party transactions. I'm saying all transactions with the related party has to be approved by the board, irrespective of the ordinary course, ALP or limits, things like that. And where is ACB required? Audit committee of the board is required for all listed companies and for all public companies with paid up capital of more than 10 crores, borrowings or deposits of more than 50 crores, or turnover of more than 100 crores. Any one of them in a public limited company, then they have to have it. In all, of course, listed companies, they should be there. So for private limited companies, there is no need to have a audit committee of the board. Audit committee of the board can give omnibus approvals for related party transactions on annual basis, and holding subsidiary, associate and fellow subsidiary not to be treated as related party transaction in case of private companies, which we have already seen. Our institute has given how to see the related parties and things like that. If there is a breach, there is huge penalty. I mean, not as huge as it was for deposits. First of all, if there is a breach, it can always be ratified either by the board or by the shareholder, as the case may be. Until such time, it could be considered as voidable. And penal consequences, if it is a listed company, 25,000 to 5 lakh rupees and an imprisonment of up to 1 year. For other companies, 25,000 to 5 lakhs. There are certain disclosures required to be made as an annexure to the board report whenever there are transactions. Details of contracts, arrangements and transactions not at arm's length basis. Details of transactions, material contracts. Contract means materiality. Contracts or arrangements or transactions at arm's length. What is material is told. Then if there is a deviation, what is to be reported is told in the guidance note. If auditor comes across any non-compliances or differences in opinion, then it should be reported in the following format. What is the nature of related party transaction and underlying transaction? What is the amount involved? And what are the details of non-compliances? There could also be key audit matter under SA 701. Under SA 701, a company can disclose that the related party if all the sales are happening to a company in which is considered to be a related party transaction, then I as an auditor have to, in the case of a listed company, key audit matter has to be disclosed. And this could be a key audit matter in one of the companies. It has been disclosed like this. RPT, the gross revenue of the company is mainly from related party. Determination of the arm's length transaction is dependent on various business decisions and judgments made by the management. So refer to note, we refer to the financial statement. And as an auditor, how did I satisfy that it was all done in a compliant manner is what my response should be. And also when I'm talking about related party transaction, I have to cross-verify whether there are any specified domestic transaction transfer pricing reports, section 40A to be reportings that is required. So I come to the end of my session of related party transactions. And now I throw open the session to the 28 or more questions that you have.
Thank you, sir.
Yeah.
For taking time and like explaining the provisions of the section so well, and we were getting responses on the chat box that everybody was liking it. So first we'll go with the question answer, sir.
Yes, please.
Okay. So the first question, so I'm going from related party to back to MSME. Okay.
Okay.
So the first question I have is whether the resolution in general meeting be before accepting deposit. If it is post accept deposit, what happens if member reject the proposal?
While it is very clear, I mean, I would like to close the presentation, but maybe some of the presentations I may have to show. So therefore, I'm keeping the presentation open for some time. While I have told that the approval has to be prior. I mean, if you see my presentation here, I've used the word very consciously as that is there in the, I think, board consent plus prior ordinary resolution. That means the approval from the shareholder should be taken before entering into the transactions. If it is not done, then it is voidable at the option of the shareholder or the director, as the case may be. If any one of them rejected, then the transaction has to be reversed. The transaction has to be reversed, and whatever money has been paid has to be returned back.
Okay, thank you, sir. Next question, sir. In a related party transaction of private limited company, do we have to get board prior approval, including total value for the whole year? Also, what is the time to get this approval during the year? Can this be ratified post the transaction done?
As I told you, it has to be before. There is no time limit specified. While you can take a omnibus approval from the audit committee, they have not talked about the omnibus approval for the board or from the AGM. You can probably do that, and there is no bar also. You can do that. It is definitely before entering the transaction. If you do that afterwards, if it is ratified, there is no problem. If it is not ratified, then you are seriously in trouble to return that particular money and reverse the transaction.
Okay. So next question is, in MBP 1, should the director disclose interest of his relative in other companies? The form does not have such a field. So the participant is just trying to understand.
I think if there is no, if the form does not have the column for disclosing it, then you cannot disclose it. But in the form of good corporate governance, definitely I have to disclose my relatives' names also.
Okay. Okay, sir.
Sometimes, while the relatives are related parties, the disclosure of them have to be given. Otherwise, they will not. The company, let us say, a true board will not know who my in-law, etc. are. So it's in good practice that I have to give who my relatives are.
Okay, sir. I hope that answered the query. Will transfer of security deposit and transfer of lease from one company to fellow subsidiary be covered by section 188 subsection 1, though there is no leasing transaction between these companies?
This must be asked by Manish. I mean, he sent me a separate mail also yesterday. I was not able to. I need to understand this transaction properly. I mean,
yeah, more background is required.
Yeah, more background is required for me to answer it. But very clearly, the point I'm saying is, in the case of deposits, anything which is taken as security deposit will not be considered as deposits. Right. In relation to deposits or in relation to related party transaction?
This is in relation to deposits, sir.
In relation to deposits means if it is a security deposit which is taken, no problem. No, you can take it as a security deposit without any conditions.
Okay, sir.
As it is clear that it is a related part. I mean, it is a security deposit.
Okay, sir. So the next question is, can one-time return DPT3 be filed now? So this is something compliance-related question somebody have
Yes,
doubt.
you can file under the CLSS. That is also possible to file. So please file it.
Okay. Then
Before 30th
deposit.
September.
Sorry, sir. So can I
Before
continue?
30th September. Yeah, no, before 30th September, unless it gets extended.
Okay, so before 30th September, we can still file it.
Yes, without additional fee. Yeah.
Okay, sir. The next question is, deposit in trust. What could be the characteristic to prove that the deposit has been received in trust?
This is the point number 11, non-interest bearing amount and held in trust. Now this becomes a very debatable thing. Debatable if I prove that this somebody has given it to me in trust and I am not paying him an interest. I think that statement as given by the other depositor should be sufficient, because normally what happens is, as I told you, it is to protect the gullible depositor. And the depositor invests in you because you are paying high interest. If somebody is saying, I don't want interest, you please hold this money under trust, then to that extent, he is not considered to be a gullible depositor. Unless
Right.
gun on his head and said, you must give that money to me. He can always say that, it was done not in, what I say, in a free and fair manner. That can also be had. But if somebody is giving it under trust, I think that should be sufficient between the company and the depositor. It is anybody else to prove otherwise.
Okay. Okay. So the next question is with regard to intercompany deposits. So the participant wants to get a clarification that intercompany deposit, can it be accepted by a private limited company or only by public limited company?
Any company to any company.
Any company.
So a private limited company can take from public, a private can take from private, a public can take from public, a public can take from private.
So all permutation combination is possible.
They use the word any other company. That's it.
Okay. Then, sir, please clarify whether a holding company, which is a private limited company, can accept deposits from its members. There's slight confusion on the three conditions that you have mentioned in your slide.
Yeah, what is that? No confusion. I don't have any confusion. Okay. Not an associate or subsidiary. Okay. So then I say the three conditions are, the company should not be an associate or subsidiary. The company borrowing divided by paid up capital should be less than 2, or the company's borrowing, to put it other way words in mathematical terms, divided by paid up capital should be less than 2, or paid up capital should be less than 2 times the borrowing, and or the borrowing should be less than 50 crores, or no default in repayment of such borrowings.
I think
any of these conditions
this clarifies.
Yeah.
So moving on to the next question. In the case of company carrying on business of vehicle dealership collects the booking advance, neither booking advance is collected, but sale has not happened, nor the advance is refunded for more than 4 years. The customer did not turn up. Now, is this amount, to hold this amount, is the violation of deposit rules?
Yes, it is in violation of deposit rule. Either you have to go in search of the depositor and give it back to him, or give it to Deepa ji and Gururaj Acharya ji. I mean, just as a matter of joke.
Charity.
But then, on a serious note, you will have to, if you are not able to find out the customer, then you forfeit this amount and pay the GST and income tax on this and close the matter. And when if and when he comes, you may have to return it back to him. That's a different issue. So you can always have the option of forfeiting this amount and offering it as income.
Income, right. So next question, if company receives advance payment for supply of material and after billing some amount is lying to credit of party for refund but pending for more than 365 days, whether the same will be considered as deposit under the Act?
Answered already, same thing.
Same thing would get applied. Yeah.
Yes, yeah.
Whether separate disclosure is required for amount due to MSME in expense payable?
No, not required.
Not required.
See, finally payable, I mean, expense payable means if it is talked about trade payables in the balance sheet, finally trade payables in the balance sheet, if he is talking about trade payable means those for which goods are traded. I mean, that is
Right.
the question that it is, and therefore expenses are not trade payable if that is the, like for example, an audit fee. An audit fee which is due to the auditor. I have taken a MSc registration, SME registration. Then whether that should come as a separate thing, the answer is no. It's only for trade payable it is required.
Okay.
That's a very good question. Yeah.
Then the next question is, sir, can a new corporate concern would not get the MSME registration till it files its first year ITR? What about such registration if he opts to offer his income under 44AD presumptive taxation?
Yeah. So what they have done is, for all such cases, for the first year, they have linked it up to your statement. You can make a statement, and based on your purchase price and your turnover that is happened, because you are a new company, no turnover happened, and therefore your purchase price itself becomes the basis. They have allowed for registration for the first year on your statement basis.
Okay.
For 44AD, I don't have an answer immediately. They have also not probably visualized. I don't know in ITR 3, that is, where file for
ITR 4, sir.
ITR 4, yeah. ITR 1, 2, ka 4. When I always say this, 1, 2, ka 4 is very simple. 1, 2 is for no business cases, and 4 is for low BP cases. Low business cases. And tell me, Deepali, in low BP cases, are we filing turnover? The answer is yes.
Yes.
As a basis. Are we filing the return on value of the asset? The answer is maybe no.
No.
Right? The answer is no. So that is a question saying that how will the WDB be mapped from a 44AD cases? I think KSCA should place this before the ministry now. I don't have an answer for that immediately.
Okay. Sir, one more question I have, that is whether the resolution, sorry, one second, sir. That question I've already asked. Sir, kindly detail a bit on how Caro focuses on interest paid on loan taken from directors, which is not a deposit, but is a related party transaction.
Let me tell you, deposits which are taken from directors is not a matter of related party transactions under 188. So therefore, it has to just go through provisions. It has to go through deposit provisions, and not necessarily, because the company is collecting deposits from directors, right? In this case, it's collecting deposits from directors. So interest in the normal course, if it is given, it should be no problem, because they have not put any ceiling on the interest that is paid to the directors. So therefore, it has to just go to the audit committee if there is one. Otherwise, there is no problem. It doesn't go under 188. All finance transactions, deposits, loans, investments, shares, issue of shares, that is, issue of shares and remunerations are not covered under 188.
Sir, I have one last question to ask you. Is the section 188 applicable, and should we pass special resolution for transaction between holding and subsidiary company not at arm's length price? And the next part of the question is, so for this year, the forms can be filed by 30th September 20. Previous audit financial year is 18-19, and the figures for loan from directors of 19-20.
Let me answer the first question before I forget that. So holding subsidiary, associates and fellow subsidiaries are not treated as related party transaction in the case of private companies. In the case of public companies, they have given a small relaxation to say that in the case of a wholly owned subsidiary, in the case of a public limited company, even a holding and subsidiary is considered to be a related party transaction and approval is required. However, if the holding company happens to be a wholly owned subsidiary, that means holding company is holding all the shares of a subsidiary company, then the approval by the shareholders of holding company is sufficient for getting the general meeting approval. Subsidiary company shareholders need not apply, because however shareholder of the subsidiary company, only the holding company. So if this company shareholders are approving, then the transaction can be put through. So the answer is holding and subsidiary company considered to be related party and approval is required? The answer is yes. With only these two exceptions, for private limited companies, there is no approval required. In the case of holding and a wholly owned subsidiary company, holding company, if it approves, the transaction can go through.
Okay, sir, the next question was for this year, the forms can be filed by 30th September 20, as we already mentioned. My previous audit financial year is 18-19 and the figures for loan from directors 19-20.
Yeah.
So,
this is a big problem. DPT3, if he's talking about DPT3,
yes.
DPT3 has to be filed by 30th of June. At 30th of June, my numbers are not ready. How do I file it? Because we don't know how much is the advance from sale and how much of it will become actually sale. That gets finalized. So what they're expecting is your audit should not determine how much is sale. So you should be ready by 30th June. In fact, I've told SARC also, maybe KSC also can make this representation to say DPT3 dates. I mean, practically speaking, unless the balance sheet is finalized, I will not be able to find out how much is exempted deposit, how much is blue deposits and green deposit, red deposit in that sense. So therefore, I should be given more time. So it would be good if they extend the filing of DPT3 in the normal situation up to, let us say, in line with the AOC4. In line with the AOC4. That presentation which can go from your committee.
Okay. So there are more questions coming in. So, sir, shall we take for another 5 minutes and then close?
I mean, I am okay as long as you are okay. That's what I'm saying.
Okay. Sir, one question is that the interest rate in case of MSME is 3 times, whether it is bank FD rate or bond interest rate.
There is something called a bank rate. If you go to the RBI website, they say what is a bank rate. A bank rate is a rate at which banks lend to commercial banks. That is at the moment 4.25%. So 4.25% into 3 is 12.75%. So whatever interest that you have to offer, and it is highly dynamic. They have been reducing this for now because of COVID situation. Otherwise, it used to be as high as 6.5%. So depending on what time of breach it is, you have to apply that rate and give the interest at that particular rate.
One last question there. I will close after this. Should annual DPT3 be filed even for cases where there are no deposit unsecured loan transactions?
Certainly not required. Just like MSME form is required only to be filed when there is a transaction of that type, which is more than 45 days. Just like that, DPT3, what you tick here, whether it is a return deposit or an exempt deposit you have not collected anything. But please be warned. If in your balance sheet you have loan from bank, a bank loan, then it will become a green deposit. Please understand. It is a money taken which is exempted. So therefore you come under item number 3. You may be thinking collected any deposit, but a loan from bank is sufficient. So when can it be not required to be filed as you have share capital only, reserves and surplus. You have creditors and you have sundry creditors, trade payables. Only that context, because sundry creditors, trade payables are not money taken, it's only goods and services taken and amount payable. So provisions, contingent liability in that sense. But if you have taken any money, either bank or from it could be debentures, or it could be deposits or any other loans from shareholder, loans from directors or relatives of directors, then it ends up being in a green zone, and a green zone also requires DPT3 to be filed.
Okay. So, sir, thank you so much for all the answers to the questions. I think it was really interactive sessions, and all the clarification would be helpful for our members. So before we close, I just want to, for the participants, information that the PPT for today's presentation as well as the video will be uploaded in the KCA website. So if anybody wants to go through the session again and want to take benefit of the PPT, please go ahead and download it from there, and it would be helpful for all of us. Next, the next session from our corporate law committee, we have it on 26th of this month. It is on audit of trust and NPOs in reference to standards on auditing by CA Aniket S. Talati. Timing is 4 p.m. to 6 p.m. So I request all members to register for the same and get benefited of these sessions and more enriched with the knowledge. So with that, I would take this opportunity to thank us today's speaker, CA Gururaj Acharya sir, on behalf of KCA for giving such an insightful session. I'm sure that the session would have clarified and benefited today's participants. Thank you, sir, for taking out time, and we hope that we will have you on board again for more such sessions. And while during the session, I saw many people putting over the chat box that they really like this session and they don't want to miss your session next time onwards. So many people have put that. So just wanted to convey that to you. I also want to thank our president, KSA President, Mr. Kumar Jigjanani, and our all EC members for organizing the webinar for the benefit of our fellow members. I also want to thank our technical team supporting us with the online platform and making it seamless session throughout. At last, I want to thank all the participants of today's webinar for taking active participation and making it a great success. Thank you, sir. Thank you, everyone.
Thank you so much. God bless you.
Thank you.